Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Reverend Drew Gysi come together to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions, so Christians everywhere can improve and strengthen their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA and SIPC. Without further ado, here are your hosts, Tim Russell and Drew Gysi.
I'm Tim Russell.
And I'm Pastor Drew Gysi.
And we welcome you to episode 98 of
the Stewardology Podcast.
We are working our way to 100, man.
Oh, man,
we're getting so close.
We are.
I can feel it.
I hope you can. This is wonderful. Well, Tim, I don't know about you, but I often raise that proverbial white flag of surrender in conversations or projects that I'm doing. I just did a project recently in my garage. I had to call in an expert because I didn't know how to handle some electrical components there. Mm-hmm. If I don't know something, I'm quick to make it known. I'm quick to seek out other knowledge and understanding or experts, advice, input, guidance, whatever it may be.
A sign of wisdom is not that you know all the answers, but you know when you don't have the answers and you know who to go to get those answers.
And I do that often. And that's how I learn from research, from reading, from others. There is a famed astrophysicist, Neil deGrasse Tyson. deGrasse Tyson. And if I understand right, I would just learn this, that he is not...
No friend of Christianity.
No friend of Christianity whatsoever. But this is what he said. There is no shame in not knowing. The problem arises when irrational thought and attendant behavior fill the vacuum left by ignorance.
So here's what he's saying. Look, if you don't know the answer to something, that's not a problem. Don't be afraid or embarrassed by the fact that you don't have answers to questions that you're asking.
Yeah.
The problem is when you allow irrational thinking and irrational behaviors, attendant behaviors, what it means, to kind of fill in your ignorance. So you start moving and behaving on your ignorance without informing your ignorance with wise advice and counsel. And from Neil's perspective, he's not saying that there's actually answers to these questions. He's actually saying, hey, embrace the ambiguity and the fact that we don't have answers. Just don't act like an idiot. What we're saying is in the area of life and finance, don't move into a behavior or an action that you don't understand how it's going to cause a certain consequence or response.
Well said.
Get advice. Seek counsel. That is wise.
So in this episode, we want to help you, if you lack the knowledge of investing during inflationary times, we want to help you to not have that empty void aspect, because we have an expert on the show today. You're going to have some good wisdom and insight, and that's going to be coming from
who are you inviting onto the show? I didn't know we had anyone else coming on.
There's a microphone right across from me, Tim, and you are in that seat.
Boy, we're in trouble now.
You are in that seat. So, Tim, in this episode, how to approach investing during recessionary times, and Tim, you're the expert here. We got 3 breakdowns of this episode. What not to do with your investing during recessionary times, what to do with your investing during recessionary times, and some good, solid scenarios that we're going to be taking a look at to review and learn from. So, Tim, with that in mind, let's take a look at what we ought to not do. What's the first thing?
Now is not the time to panic. Sometimes I chuckle when we get phone calls from clients or individuals that we know in the community who read something online or saw the latest news article or saw the latest tick of the stock market down, and they're starting to, there's a little hyperventilating and that little anxious and feeling overwhelmed by all of the emotions. And look, emotions are usually, these are things that are unbidden. You don't decide to have an anxiety attack, or you don't decide to panic.
Yeah.
But you put yourself in conditions that make it more likely that you would have one of those emotional type of a response. So especially when it comes to recessions and bear markets, and remember what we talked about in our last episode, that a recession and bear market, they're not the same thing.
Not the same.
Just because we have a bear market doesn't mean we have a recession. But oftentimes when we have a recession and a bear market, they go like a recession, a bear market goes with it.
Yeah.
So let's hypothetically assume we're going to be in a bear market. Now is not the time to panic. Don't light your hair on fire and run around screaming, thinking that the world is coming to an end or that the sky is falling. Don't do a knee-jerk reaction. So we talk about panic, and panic is one thing, but the panic response is then typically a knee-jerk reaction.
Yeah.
So what does that look like on the investing world? That typically would look like selling everything and moving to cash or gold, or you fill in the blank, Bitcoin, or
Tim,
people are probably not running to Bitcoin right now, but
I'm seeing this a lot on radio, TV, satellite radio, you name it, on podcasts. I'm hearing just an extraordinary amount of commercials on silver and precious metals and gold and stuff right now today, more than I've heard in the previous few years.
Yeah.
So I think they're trying to capitalize on this knee-jerk reaction.
Yeah. So don't panic. Don't have a knee-jerk reaction. Another don't that I actually don't have in the list that kind of fills in with this is don't watch the news media, and especially the financial news media, the CNBCs and whatever else of the world, if you're already feeling anxious and worried. Why? Because they're not about truth and transparency. They're about selling ads. And what sells ads? There are two things: fear and sex.
Yeah.
And if we can fit both of them into one ad, that's even better. So anytime that the news media can get you afraid, they can get you motivated to take action to protect yourself from the boogeyman. You never see a news story that says, next up at 12 or at the 10 o'clock news, find out why life is going to be better in a year from now. Like, that doesn't sell ads. No. That doesn't drive listeners. But oh my word, people will come and find out why they're about to die from the latest strain of monkeypox.
Right.
People are motivated by fear. So don't panic. Don't allow yourself those knee-jerk reactions. Don't tune in to triggering news articles and media. So that includes podcasts. That includes radio, television. Lots of different things can be used to trigger emotional responses.
What's another thing on the list?
So I've got two more things that you should probably not do. But how about don't become jaded and embittered, right?
What do you mean by that?
Well, I mean by that, you watch the market drop and you see your account values decline, and all of a sudden you think that this whole investing thing is rigged. It's only for the rich. The rich get richer and the poor get poorer.
Oh,
it's all about the those with power taking it from those who don't. All of a sudden they think, I had $500,000 in my IRA. Now I have $400,000 in my IRA. Someone stole my money. Where did it go? No one stole your money. You have exactly the same number of shares, if not more, than when you had $500,000. Right. Just the price per share has decreased because the companies in that portfolio have decreased in their relative value temporarily. So don't jump to conclusions that the whole thing is rigged. Markets take time. If you have Look, markets reward individuals with a long-term time frame.
Say that again, Tim, because that's such a key thing for people to hear today because of all that they're hearing, seeing, and do I invest? Say that again.
Markets reward long-term time frames. It is true. If you come to investing thinking that I'm going to get rich quickly, this is the fastest way to $1 million. And in many ways, it is one of the fastest way to become rich and have wealth. But it's not a get rich quick scheme. It is a long-term plan to be steady over time. The markets tend to reward those with long-term perspectives.
And Tim, that's such a good thing for our listening audience to have, to not become jaded or embittered. And if they're getting their quarterly statements, if they are investing and they take a look at it, they can get scared real quick. And it's important for them to kind of pull back on that at this time. You have another thing in that list.
Yeah, this is more of a tactical thing. This is if you are charitably inclined and you're going to donate, we talk about donating highly appreciated shares of stock. Yeah. The thing not to do would be to ever donate a share that's in a loss status. So let me give you an example. You bought a stock for $50. It's now worth $10.
That's a problem.
That's an 80% drop in value. That's
a problem.
Really painful. Well, you would never want to then donate that share worth $10 a share, because you don't get the tax loss on that. So what you would do in this circumstance is you would sell it at $10 a share. You would then take a $40 per share loss that you can write off in your tax return, and then you would donate the dollars, not the shares, the $10 that you get per share. You would donate those dollars, and then you get the charitable deduction. So you get the loss, and then you get the deduction.
So it's a tactical way to take care of that.
Yeah. So this is actually more of a tactical. Don't do this. Don't donate something in a loss for tax reasons, for charitable reasons.
Tim, there's a chart that we're going to actually put up on our show notes. Can you kind of express that with words to our listening audience?
So this chart comes from JP Morgan Asset Management. They have a monthly or quarterly, they'll put out an update to their JP Morgan Guide to the Market. And it's fascinating. I love looking through this and seeing all the charts and graphs. And this one graph I've used numerous times. It shows the annual returns and intra-year declines. First thing I need everyone to do is take a big, deep breath. Yeah. Market declines are normal. So if you look at the past 42 years of the S&P 500, we've had a positive return 32 out of 42 years.
That's good.
That's 3 out of 4 years are a positive year in the market. 1 out of 4 years is usually a negative. That's at the end of the year, going 12 months at the end of the year, you're negative. Mm-hmm. However, did you know every single one of those 42 years, the market at some point in the year was actually negative?
Really?
Every single year.
Well,
do you know what the average intra-year stock market decline is? We actually alluded to it in our last episode. Here's the actual figure. Do you know?
I don't, Tim.
14%.
What?
The average market decline is 14%. Do you know what the average market advance over, including all of those average inter-year declines? The market's averaging around 12% a year, including the positive years and the negative years.
That's nice.
So I need you to understand that even though this year we have been down thus far around 24%, that's not the end of the year. The markets may go lower, may go higher from there.
And as we learned in our previous episode, there could just automatically something happens, investors start putting in, and it turns around.
Absolutely. Stock markets, when they're done going down, they'll start going up. That sounds kind of obvious, but for no other reason than people looking for deals out there. They're going to scarf up some really good companies at lower prices.
So, Tim, we just looked at what not to do. What are some of the things that somebody ought to do about investing during a recession?
You know, the first thing that people should probably be doing is don't go it alone. That's a negative. Let's say it positively. Get advice. One of the things that we offer here at the Stewardology Podcast is a free stewardship review. And we talk about a stewardship review. What we have in mind here is, look, if you're investing and you want to know what you should be doing during this time frame, now's not the time to just be guessing and feeling your way through the markets. It makes sense to hire someone who, or not even hire, just to talk to someone who understands the markets, who understands investing, understands stewardship, and can help give you some perspective. This is not a veiled sales pitch. Seriously, if you are just looking for direction and advice, go to stewardologypodcast.com / I think it's review.
Yes.
And you can sign up for a free stewardship review, meet with me or Drew or one of our other Christian advisors who can just help you understand where you are, where you need to go, and how do you navigate through the gaps in between.
And Tim, there's a quote that we say often here: you don't know what you don't know. And for some of our listening audience, this may be your first time navigating these investing during a recession time. Our team here, they've gone through a handful of these, like we talked about in the last episode. Mm-hmm. Because they have gone through that, they can guide you and coach you through that time. Mm-hmm. So seriously, we want to ask you, encourage you, implore you. If you don't know, stewardologypodcast.com / review.
So generally speaking, beyond just saying, hey, talk to us, we can help give you more specific, personalized advice. Let's talk about some general pieces of advice that are going to apply to a variety of people. Often one of the best things to do when a market's going down or during a recession is nothing.
Okay, I got that one down, Tim.
just
I got that.
Sit back and do nothing. Don't pull up your statements online. You can get your statements as they come in the mail and just set them aside. Leave them there for a couple months. You can look at them later. If looking at the market while it's going down is going to incite more fear and anxiety, or tempt you to make a decision, a knee-jerk reaction that you may later regret, sometimes the best thing to do is simply nothing.
Tim,
why?
Well, let me explain why. Tim, I'm going to just share reality for me. Since January, the first week of January, I have not looked at my investment accounts. Not even once. I just know that if I did, I would probably process it in a not so positive way, knowing what the economy is, what's happened with the economy. So I have done exactly what you just said. I have chosen since January to not even look online, not see what it is. And it's so easy for me to do that, especially working here with the Life Group. I could easily just bring it up and take a quick look. And I am trusting my advisor to take care of things for me. And I am not looking at it. So I am doing what you just said. It's not like I'm going to panic and light my hair on fire because I don't have any hair because I just shaved it all off. But I think that is such good advice.
Let me give you a couple caveats, however. Right, the do nothing applies when you already have a plan in place and you're following the plan.
And I have that plan.
And your situation hasn't changed, and you're not hyper concentrated to just a handful of companies.
Correct.
If you have only one or two companies making up the bulk of your net worth, that's a problem.
That is.
And you doing nothing may actually be a problem if the company is not likely to recover. However, for the vast majority of people who are using mutual funds and ETFs that are well diversified, doing nothing is a great choice. Why do you do nothing? Because the market is not static. This is not the future. The future is different than where we are. Could be higher, could be lower, but likely over time, given enough time, the markets grow and do recover. So be patient, give it time, this too shall pass. So number 1, get advice. Number 2, don't do anything. Number 3, invest, buy more. If you're afraid, don't do anything. But if you have a long-term perspective, if you are willing to put money to work that you don't need in the next several years, yes, by all means, contribute to your 401k, buy more shares of companies that are on sale or mutual funds and ETFs that are trading for less than they were at the beginning of the year. That could be a tremendous long-term benefit. So get advice, do nothing, add more, rebalance. If you're retired and now is not the time for you to be adding more money because you're in distribution mode, one wise choice would be to rebalance your portfolio, because you sell winners and buy losers. If it's a good portfolio, you've got good holdings, that's actually going to be a positive long-term move for you, because the economy will eventually recover, the markets will begin to heal, and the portfolio is more likely to grow. Typically, in a recession, bonds are doing better and stocks are doing worse, or bond mutual funds and stock mutual funds are doing better and worse. So if you rebalance, you slightly reduce the amount of bonds and slightly increase the amount of stocks. You're not changing your overall weighting. You wanted, say, a 60-40 portfolio to begin with, and now it got skewed, so now it's back to 60-40. You're where you're supposed to be, but now you have more shares of the equity side, which when the market recovers,
it's going to bump up.
You'll see a faster recovery, generally speaking. So rebalancing is a good option.
I just found out, I was talking to my advisor, and just last week he decided it was time to rebalance my portfolio. Mm-hmm. So I was so glad to hear that he's right on top of that and doing that. And that's probably why I didn't worry about opening things up and looking at things, because I have somebody that's taking care of it for me.
Get advice, do nothing, invest more, rebalance. Fifthly, look at doing a Roth conversion. When the stock market is down, one of the best things you can do, whether you're working or you're retired, is to convert shares or money from your traditional IRA to a Roth IRA. Remember the traditional IRA, for those of you who may have forgotten. Those assets, you've never paid tax on any of the money inside a traditional IRA.
Correct.
It's all pre-tax money. It all grows tax deferred. And when you eventually take the money out of that account, you pay tax as ordinary income. For a number of reasons, especially in light of the change in the stretch RMD rules, the Secure Act 2019, doing Roth conversions now makes more sense perhaps than ever before. You, especially during a bear market, you can convert. Let's say you're going to convert $10,000. You think about doing it now versus doing it January or December of last year, January of earlier this year. If you would have done it then, you do convert $10,000, then great. But if you do it now and convert $10,000, first of all, $10,000 is a larger percentage of the overall pie because the pie has gotten a little smaller.
Right.
You're converting more percentage of your IRA to a Roth IRA by doing it during a bear market. So for many of my clients right now, we're having conversations about doing Roth conversions, because now is a fantastic time to take that income. Sometimes the income is down during a recession.
Right.
So we can take advantage of that and do a Roth conversion. When you convert, you have to pay tax. You claim the income for the amount converted. You convert $10,000. You show $10,000 of additional income on your tax return. You pay the associated tax on that. If your income is down because of recession, that may be an even better time to take advantage of that.
That's a good tactical piece.
Yeah.
Very good. Well, there's one other piece on this, Tim.
Yeah, another thing to do with a portfolio, in addition to rebalancing and Roth conversions, would be to think about doing something called tax loss harvesting. This is for non-retirement accounts. Okay, so it doesn't apply to your IRAs. You can't tax loss harvest on an IRA or a Roth IRA, 401ks or things like that. If you have a joint account with your spouse or an individual account, non-retirement money, we have that thing called cost basis. Cost basis is how much money did you pay to buy that asset. So let's say you put $50,000 into a portfolio. It grows to $50,000. We have 25 is your basis. 25 then is your gain. So 25 plus 25 equals 50. If you sell it, you've got $50,000. Or I'm sorry, you get $50,000, but you have to pay tax on 25 of gain. When you do tax loss harvesting, what you can do is you can look at your portfolio and you find one or two positions that's actually in a loss status. You can sell those investments that are currently less than what you purchased them for, and be able to claim that or get that loss to offset current or future gains. So that could be a great way of helping to reduce taxes moving forward. So tax loss harvesting is a very good idea to be able to manage taxes. You have to be aware of the wash rule. There's something called the wash sale rule.
I do wash on a regular basis.
Wash sale rule is trying to help prevent people from selling. Like I have IBM stock, hypothetically, right? And I sell IBM to take a loss because it's down, and then I repurchase the shares the same day or next week. Did I really want to get rid of AT&T? No, I just wanted to do a tax maneuver. So they call that a wash sale. If you buy or sell a stock within 60 days,
The same one. Okay.
It could be a stock or the same mutual fund. You are considered a wash sale, and it's not considered to be a sale at all. You don't get to take the loss. Your cost basis carries over. However, you can sell one S&P 500 fund and buy another S&P 500 fund, and that's because it's a different fund. Yeah, it's a different fund altogether. So it's considered a different investment. You can sell. Let's say you sell IBM and then you buy Dell. I don't know if Dell is a stock. I think Dell is a stock. But let's say you do that. Well, it's two computer companies, but they're different companies. It doesn't trigger a wash sale problem.
Gotcha. Tim, there's another chart that we're going to put on our show notes called the S&P 500 bear market since World War II.
Yep.
Can you just do a verbal explanation of this, and our listeners can probably jump into our show notes and look at it later?
This chart illustrates what I said earlier. Markets reward those with a long-term perspective. Bear markets are common. They happen with a fair amount of regularity. We said 1 out of 4 years is down. Perhaps less than 1 out of 4 is a bear market. Usually we have one every 10 years. But if we look back to 2000 or to World War II, going back to then, say 1946 is the first one on our list, going all the way through the most recent recession in 2020, what do we see? But that we have had a number of bear markets. And the amount of decline in any one of those bear markets, the average is about 32%. That's painful.
Yeah.
32%.
Very much so.
But if you take from the date of the high down to when we hit 20%, the date of 20%, 1 year later, just 12 months from the date of 20%. By the way, keep your logic with you here. If the average bear market, which is at least 20%, the average one is 32.
Okay.
So at the date of 20, we still have more negative to go.
Mm-hmm.
So from the date of 20, with more negative to go, if you look out 12 years from now, the average market return 12 months later, 1 year later, is actually positive 17.5%. Not 7.5% of the time. The average return is 17.5%.
The return itself.
Yes. The 1 year return from the 20% decline is positive 17.5%. 3 years from that 20% decline, the market, it's up 36%. And this is not compounded. This is just from point A to point B,
right.
36% increase. And the average return over 6 years is over 80%.
Wow.
Think about that. So is a bear market a terrible thing? No, it's not. markets will recover, your accounts will recover, life will go on. Take a big, deep breath.
And I think it's important for our listeners to understand that this wasn't just like a recent study. This is going back to World War II.
Yes.
And they've crunched the numbers. They looked at this, and it's a substantial return even with these difficult times.
Yeah. Now, I have to warn you, as a financial advisor, someone who's licensed and regulated by the government, I have to tell you, past performance is no guarantee of future results. And that's true. Yeah. Absolutely true.
True.
At the same time, I have nothing but history to help shape my expectations of the future.
Well said.
So it doesn't guarantee the future, but it helps to inform my expectations of what's a likely scenario.
I would encourage, I'm looking at the chart myself right now, and I would encourage our listeners, if you get a chance, jump on stewardologypodcast.com, go to the show notes for this episode, how to approach investing during a recessionary time, and take a look at this chart. It is so informative, very simple, but yet very informative. Tim, let's switch gears and let's talk about some scenarios. All of these are hypothetical scenarios. This is not investment advice. We need to make sure that caveat is out there. Yep. So, Tim, we're going to say, I'm married. I'm 30 years old. I own my home. I have 2 kids. What should I do?
We're thinking about how to invest during a recession. What do I do? 30 kids, got a job, got a home.
Hopefully not 30 kids.
Well,
that would be trouble.
Not in your 30s. That'd be for sure.
Yeah.
The first thing to do is look, you got time. So the first things first, let's focus on budget. Make sure you're living on a budget, and then let's focus on paying down your debt. That's get an emergency fund, and then let's fund your Roth IRA. So for families who are just starting out, those are the big pieces that they should be working on. Make sure you have a budget. Live on less than you earn. Yeah. That's another way of saying that. Live on less than you earn. Mm-hmm. Number 2, pay down your debt. So I'm talking about consumer debt, not necessarily your mortgage, especially if you have a low interest rate mortgage right now. Praise Jesus for that. Great. Let's knock out student loans. Let's knock out credit cards, car loans. Get rid of the consumer debt.
Right.
Build a real emergency fund, 3 to 6 months of living expenses in that ballpark. Remember, living expenses, not income, because you're living on less than you earn.
Correct.
And then we're funding our Roth IRAs.
Mm-hmm.
Those are the easy steps. And I say easy. I know they're not necessarily easy for everyone listening to this, but those are the things that I'd say are no-brainers for individuals who are in your 30s with some kids trying to figure out, what does recession mean to me? Remember what we said at the end of the last recession. How do you help recession-proof yourself? Live on less than you earn. Have reserves.
Yeah.
Right. Those are the things that I'm trying to instill in our younger generations.
And Tim, I just want to touch on the emergency fund real quick, because we're talking about these recessionary times. We just came out of pandemic times. And if some people would have had this emergency fund in place, and it would have been very, very helpful when their work shut down for them. They couldn't go to work. They weren't allowed to be out. They could have drawn from those resources, I'll say probably in a skimpy way, so they could make it last longer. But that would have been a wise choice. So if these pandemic days could teach us something additional, that is the value of an emergency fund.
Mm-hmm. All right, so our next scenario is I'm not in my 30s anymore. I'm 50 years old. I've got $300,000 invested in my 401k. My kids are finishing up college in the next couple of years. What do I do?
That's a great question.
So here, the way I approach it is, look, keep your risk levels the same in your retirement accounts. Now is not the time to reduce risk. If you are a well-balanced investor, you've got a good mix of stocks, and you also have a couple bonds, now would not be the time to dramatically reduce risk. So sell everything, go to cash, or increase the amount of bond holdings you have. However, if you are hyper-conservative already, having a lot of cash or a lot of bonds, now might be a fantastic time with a long-term perspective to become more aggressive.
Yeah.
So don't reduce risk. If anything, there may be an opportunity with a long enough perspective and a high enough risk tolerance to actually increase your risk allocation, expecting that we will have a recovery. So that'd be the first thing I tell you to do. The next thing would be to make sure that you're funding your Roth IRAs. One of the things I see very common for retirees or people approaching retirement coming to me, they often don't have any or anywhere near enough money on the Roth IRA side of their portfolio picture. They're almost entirely focused on traditional 401ks, traditional IRAs, very little on the Roth side. And when you're thinking about the compounding effect of that money over time and what that might mean to your children as they have 10 years to withdraw all of those funds and realize all of those taxes after your death, having more Roth IRA is going to help you while you're alive, and it's also going to be more tax efficient for your children.
Yeah. Yeah.
So then consolidate 401ks. If you have multiple previous employers and multiple previous 401ks that you've got scattered hither and yon, it would really behoove you to start gathering them all up. So if you don't have an IRA already existing, you can go to one of the big firms, the Fidelities, the Schwabs, the Vanguards of the world. You can open up an IRA and then you can roll over 401ks into that one account. If you're working with an advisor, they'll help you to do that. So for example, if you want to figure out how that would work for you, you could reach out to us. We'd be happy to talk to you about that. If it makes sense for you and us, we can see about engaging in a relationship to be able to assist you with doing those rollovers. But that is a wise move because it's so easy to miss things. You know, you've got a couple 401ks, but you forgot about the one that was 20 years ago at that company that you'd rather forget that you had a tenure at, right?
Tim, do you hear that often?
I do. I do. In fact, I'm working with one client right now. Her husband passed away. Dear woman, had cancer. And in her particular circumstance, there was one piece of the retirement that neither she nor her husband knew that they had. So I actually met with them before he was diagnosed with cancer. We did a review and went through everything. He didn't even know he had this until he passed away. She filed for Social Security, and the Social Security Administration said, hey, I don't know if you know this or not, but over here at this company, there's a retirement account with his name on it. You may want to go talk to them about that.
Wow.
Thank you. We'll go ahead and do that.
Nice.
So, yeah, it does happen.
Good.
I've actually had people come into me and they've got a spreadsheet with 10 different accounts from prior 401ks, and they've got to maintain. Think about the logistics of this.
Yeah.
You've got all those statements.
Crazy.
You've got all those sign-ins. Mm-hmm. You've got all those different accounts and remembering what you're holding in each one of those accounts. How do you manage that effectively?
Yeah.
How do you be a good steward when it's spread over those many accounts to really be able to tactically take advantage of opportunities or manage the risk that you're facing in the markets? So consolidation, a wise move.
Sure.
All right. So what else? Roth conversions. Another thing to pay attention to. Got your funding your Roth IRAs. I would also encourage you take advantage of the market downturn, do a Roth conversion, pay attention to taxable income, and especially if you have kids going to college and you're filling out FAFSA forms.
Oh, the dreaded form.
Just make sure that your Roth conversion is not going to cause a problem with financial aid.
Yeah.
So bear that in mind. Again, it depends on the situation, but if you're not expecting much in the way of aid, I would not do a Roth conversion just because you're afraid of losing some small amount of aid. Your long-term benefits in the Roth IRA is probably going to far outweigh any small amount of aid you might get. So bear that in mind.
I remember when I was getting ready to go to college, I was just married, but I was working. They told me about financial aid that I could get potentially. Well, my dad did an early retirement and he had a lump sum come his way.
Oh, yeah.
And that radically impacted any possibility for me to be able to have that financial aid. So, Tim, your advice there is well taken.
Pay attention.
So, Tim, let's take a look at another scenario. I'm 66, retiring next year. I have $800,000 invested. I'm afraid that I'm going to run out of money. Tim, what should I do?
Man, I hear you. First of all, congratulations. I mean, having $800,000 already puts you in the top 10% of retirement savers. And that's a good deal. When I think about that, you have Social Security and pensions. Look, we have to kind of figure out, what do you expect for income? Yeah. Let's figure out your budget. So you're 66, looking to retire next year. Job number one, what's your budget?
Yeah.
What are your by budget? I'm sorry. What are the sources of income to fund your budget?
Right.
So that's Social Security, pensions, part-time work, investment income. Add up all of those sources of income or potential income. From there, we've got to figure out what your actual expenses are, your budget. What are you spending money on?
Yeah.
So where are you spending money now? The reality is your expenses are going to be fairly predictable in a year from now, other than inflation. I know inflation is a bit of a kind of it's something that's a little harder to get your hands around. But because you either have a mortgage, you don't have a mortgage, you'll either have a mortgage in a year or you won't have a mortgage in a year. You probably know that now. You know what you're spending on utilities. You know what you're spending for, generally speaking, for food and gas. Some expenses you'll have less. So taxes theoretically are going to be lower, and maybe travel expenses may be a little lower unless you're planning on doing a lot of travel early on. Wardrobe costs are going to be lower. So we can guesstimate what that budget's going to look like. So we have income, now we have expenses. Let's figure that out. The next component would be, hey, I want you to be debt free in retirement, including your mortgage.
Yes.
So if you're 66 and looking at retirement, man, I would be hammering that mortgage, making sure it's gone. Ideally, I would love for everyone's mortgage to be finalized at 60, but that's not a reality. I understand that. So for some people, you are going to be carrying a mortgage into retirement. But the point here is, if you're in that pre-retirement stage, you want to eliminate as much nonsense debt as you can. Knock out credit cards, knock out car loans. You don't need to be carrying that into retirement. Why? Because the best predictor of not running out of money is not necessarily how you invest your money. That's part of it. It's actually how much of your income do you actually have a say over. The more debt you have, the less of your income you actually have a say over.
That's very well said, Tim.
The creditors have a claim to your income.
Yeah.
And they have a claim for your income for as long as that term of that repayment schedule is there. So that gives you that much less flexibility with inflation, that much less flexibility when the stock market goes down. Having no debt going into retirement gives you maximum amount of flexibility in dealing with inflation and stock market declines.
The borrower is slave to the lender.
Yeah.
And Tim, do you find this, that you see this often, that people that are getting ready to approach retirement years, that they do have debt, as in housing and consumer debt? They're seeing quite a bit of that going into those, more so today than ever before?
You know, it depends. Actually, I think that you have $800,000. The average person that I meet with $800,000 401k a year from retirement, most of them have been able to pay off their mortgage. Mm-hmm. Most of them. When we're getting down into, I've got $100,000 to $300,000, I find maybe more than 50% of them are still carrying a mortgage, and that's concerning.
Yes,
and I'm, which one causes which? That's a question maybe for a different podcast, but there is a correlation between having a mortgage and not being able to grow your retirement savings. Maybe it's caused by just generally lower income. Maybe it's caused by life priorities and expense situations. But those who are able to prioritize getting out of their mortgage debt often are able to enhance the amount of money they have saved for retirement. All right, next piece. Roth conversions, I've explained this enough. I'm not going to go into a tremendous amount of detail, but still, even at age 66, doing a Roth conversion can make a tremendous amount of sense. Be aware of timing and tax brackets. So if you are in a very high income tax year and maybe you're going to have a large payout this year, typically at the end of your career, you're at the higher end of your income wage earning spectrum. It may not be the best year to do the Roth conversion. Maybe waiting until next year and doing a Roth conversion when you have less income may be a better tactical move. But regardless of the tax tactic, one strategy is to increase the amount of Roth money you have. So funding Roth IRAs, doing Roth conversions, while understanding their tax impact may be a tremendous long-term move.
And this may be one of those times when you don't know what you don't know and reach out to a tax professional or a financial advisor. They can walk you through what would be best for you.
Yeah. So next would be do that portfolio rebalance.
Yeah.
If you don't have more money to put in, you can't do a Roth conversion, at least you can rebalance the portfolio. We talked about why that would be wise. And then another option that I don't think is right for everyone and sometimes is way oversold. But if you're really concerned about running out of money, the stock market decline, looking at a Great Depression, Great Recession, an annuity is an option to give you some peace of mind. There are a number of very interesting annuity options out there today that could help give you some buffers for some bad times with some upside potential. So this is not a specific recommendation for any particular product, but annuities may have a place in the plan given your age, time frame to retirement, need for income, and fear and anxiety about the markets.
Yeah.
And then a final piece would be to revisit risk as the markets recover. Look, if your risk level is high, now is not the time to go to zero risk. You're a year out from retirement. Let's let the markets recover. Maybe if we need to delay a little bit of retirement as we allow the markets to recover, that assuming your health is working and you're physically able to continue to work, it may not be a bad option. But you don't want to go to zero risk when you retire. When you retire, you shouldn't go from 60-40 to 0-100. So stock to bond mix, 0 stocks, 100 bonds, or 100 cash. That'd be a bad move. Why? Inflation. The fact that, the average life expectancy once you get to 75 is easily 90s and beyond.
Yeah.
That's a long time to be in retirement. 25 plus years without any potential buffer to grow with inflation. You need to have equities.
Yeah.
So 60-40 is a good place to shoot for in retirement and even through retirement, I would say.
So Tim, next scenario, I'm 75, retired with $600,000 and I'm taking $2,000 a month out of my accounts. What should I do there?
Well, one of the questions I'd ask is how much cash is in your portfolio right now? If you have less than 6 months cash, that would be what, $12,000, $2,000 times 6 is $12,000. You may want to consider raising cash. Even while the market is down, you still need to have adequate liquidity. And because I don't know what the direction of the market's going to be over the next 6 to 12 months, generally speaking, it's higher, but it's not always higher. You can look at that chart. Some years are still down after a year.
Sure.
I would rather have some of that reserve. So right now, I would increase some cash if you're running low in your portfolio. So that may mean selling some stocks, maybe some bonds, so that you have enough cash on hand to meet your current and immediately future income needs. The next piece would be to reduce your withdrawal rate if you are able to. So if you're 75, so you're in RMD age. If you're taking out from your IRAs and other accounts greater than the required minimum distribution, you may want to cut it back to only the required minimum distribution. Or if you don't need that required minimum distribution, do that as a QCD, which is another recommendation. Do QCD, qualified charitable distributions. Or
to your local church would be one.
That's right. Or take your RMD and reinvest it back into your taxable account. So you're actually not taking money out of the market. You're simply changing under which shell the P is in, right? Is the P under the IRA bucket or is it in the taxable bucket? You can just kind of slide it from one bucket to another bucket.
No, I love those things.
And then look at Roth conversions. Roth conversions are still a good option for individuals who are in retirement, although you have to be careful of Medicare surcharge. There are lots of different things to pay attention to. This is where it really can help to talk to an advisor, especially if you're in a low income tax bracket. Roth conversions could be a tremendous opportunity.
So Tim, our last scenario, I just inherited $500,000 from my mom in an IRA, $400,000 and...
Well, you just inherited $500,000. 400 is in an IRA.
Oh, 400.
100 is in a Roth IRA. Now, what should I do?
Yeah.
Okay. So here's where I mentioned earlier, the 2019 Secure Act changed everything for this hypothetical person. The parent died theoretically or assumably they died post 2020, which means that this individual has 10 years to withdraw every penny out of the IRA and Roth IRA. The rule applies to both IRAs and Roth IRAs. Within 10 years of the date of death, December 31st of the 10th year of the date of death, they must withdraw 100% of those two accounts. So the way I would address this is, first of all, do not touch the Roth IRA. Allow that to go. Again, this is under current rules, and there is some potential that this may be disallowed in the future when the IRS updates its guidance. But under current rules, you would be able to defer taking any distributions from the Roth IRA until the year 10. That would allow 10 years of tax-free growth.
Love that.
So yeah, right now, what I would be doing is maybe increasing the risk level inside that Roth IRA, thinking that you're not going to need it for 10 years and allow it to grow tax-free for 10 years. For the IRA, I would start doing some withdrawal planning. So look at your current income, plan for how you can realize that $400,000, maybe $40,000 some odd dollars a year for the next 10 years until you deplete that account. Mm-hmm. Again, if it's invested, you may at $40,000 withdraw $400,000, but the account still may have $100,000 in it because of market growth.
Right.
So you have to be aware of where you are in that time frame and be withdrawing how many years you have left of that account. 1/10, 1/9, 1/8 every year you get closer. So those are the ways that I would address that. And then don't withdraw funds from any of these accounts if you have a really high tax year and you expect the following year may be lower. Mm-hmm. So that gives you have some flexibility to plan your withdrawals.
So a lot of it is strategic with taxes is what I'm hearing there.
Here's one thing you can't do. You cannot do a Roth conversion from an inherited IRA to an inherited Roth IRA or an inherited IRA to my personal Roth IRA. You can't do Roth conversions. You can do a withdrawal from the IRA, and then you can make a contribution to your Roth, but you can't do a conversion.
But you can do your contribution within the limits.
Yeah, and so a Roth conversion, there is no limit to the amount that you can convert.
Correct.
You could do $10,000. You could do $100,000. When you do a contribution, it's $6,000 or $7,000, depending on your age. That's the maximum amount you can contribute. If you're married, then maybe for both spouses, you can do a contribution. Again, assuming you qualify for Roth IRAs with the income limitations. And again, you may be disqualified from Roth IRAs if you have to take an RMD from an IRA that's $100,000. Mm-hmm. That could disqualify.
Getting a little into the technical aspect of it. That's where a financial advisor or a tax professional can walk you through this to make it really work out for you. There's a chart there, equity scenarios. It's called bull, bear, and in between. And Tim, give a verbal on this, and we encourage our listeners to take a look at this on our show notes.
So this chart gives us two pieces of information. The first piece of information is how long at what rate of return would it take for us to recover our January 2022 peak price in the S&P 500. So for example, if we had a 28% return, we would recover within a year. If it was a 14% return, it would be 2 years and so forth. Kind of outlines what the average return would need to be to get back to that peak.
Gotcha.
The second piece of information is it actually shows us the various bull markets and the various bear markets and how long each of the bulls and the bears lasted. I find this really interesting. The average growth in a bull market is 162%.
That's fascinating.
The average duration of a bull market is about 51 months. It's like 6 years.
Yeah.
It's a long time. So, that's not 6 years. 60 months is 6 years, or is 5 years.
5 years.
It's 4.5 years, somewhere in that ballpark. Anyway, the average bear market declines in this framework. It actually includes the Great Depression, includes a negative 40%. Earlier, we talked about the average downturn is somewhere around a negative 7%. That's an negative 17. That's an intra-year low. But if we just take the bear markets, which is only looking at the really bad ones, we're looking at a negative 40 and a duration of 20 months. So this is telling us that the markets decline. The market's decline can be significant, but the advances always outweigh the decline. The advances, both in terms of percentage and in terms of the length of time, are greater than and longer than a bear market. So it feels bad today. You're looking out at the stock market down 24%, and you're feeling, how frustrating. However, what I'm telling you is that be patient. This will come to an end. The next bull market will be established and we will recover. This too shall pass.
And this is a good reminder of history teaching us the potential of what the future may look like. We don't say for sure, but it's that potential. And Tim, this is where a personal stewardship review falls into place for people. Am I right in saying that?
That's right.
So we, again, encourage you, stewardologypodcast.com/review. As we close out this time, I want to go through a few verses of Scripture. Psalm 1, it says this, "Blessed is a man who walks not in the counsel of the wicked." So we encourage you, choose to seek out not just counsel in what you don't know or what you could know better, but also seek godly counsel. Find someone of like faith, someone who has your values and passion for God and His Word, and lean into them for counsel and wisdom in your financial planning and your financial decisions. Proverbs 12:15 says this, "The way of the fool is right in his own eyes, but a wise man listens to advice." And Proverbs 1:5 says, "Let the wise hear and increase in learning, and the one who understands obtain guidance." So increase your learning, and you're doing so right now through this podcast. And one of the ways that you can do that is signing up for your free, no sales pitch, no obligation, personal stewardship review. Our passion here at Stewardology, at Life Financial Group, at Life Institute is to help believers become even better stewards of all that God has placed into your care. Reach out to us as your trusted guide in putting a plan together and to use what God has blessed you with for your family and for kingdom purposes. So we want to say thank you for joining us on this episode of the Stewardology Podcast. Send us your questions, your comments, and your thoughts at stewardologypodcast.com/idea. And I already mentioned multiple times about the stewardship reviews. Consider joining us and give us a call. Reach out to us through our website. We would love to hear from you.
All right. Until next time, take care. God bless and keep calm and invest on.
Thank you for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. First, subscribe in your podcast provider to get the newest episode delivered to you every week. Next, follow us on social media and visit our website at stewardologypodcast.com. There you can find our social media links and our entire episode archive. Remember, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week on the Stewardology Podcast. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.